Okay. Good afternoon. I want to thank Chairman Choi and the organizers for inviting me to talk to you. It's a great honor to be able to do that. The title of my talk has to do with the fact that this conference is about hyper-uncertainty. And when I heard about that, I thought, well, let's look at the financial markets, whether they reflect that. And I had trouble finding it, so that's a puzzle. We talk about hyper-uncertainty, but the financial markets don't have many indicia of that. And so the question is, why not? And now when you look at the financial markets, the traditional measure of uncertainty is the VIX. Now the VIX reflects the implied volatilities of index options. And so that's the VIX since 1986 when it was started. And you can see that it has reached some rather impressive spikes. The most recent one with the crisis, the global financial crisis. But you can see what kind of is a puzzle to me, which is when you look at the VIX at the end of or the beginning of this year, now it has the lowest level since the early 1990s. Okay, so from the perspective of the VIX, uncertainty has never been this low since the beginning of the 1990s. Now it was very low in January of 1994, which it was just before Greenspan increased the interest rate, and we had some trouble in the U.S. But you can see then that it was quite low in 1996, just before the first, the Asian crisis, and then went very high. So the first time I came to Korea was in 1997, when the VIX was quite high, and was quite high compared to today. If you look at the Korean VIX, now the story is about the same. The graph I have here stops in March. It might have gone up since then. But you see, again, a very low value of the VIX. When you look at Japan, same story. When you look at China, in fact, it has never been this low. Okay, so looking at the VIX measure, whether we look at it in the US or whether we could look at it in the Asian countries, it's extremely low. And so by that measure, we are not in an age of hyper-uncertainty, but we are in an age of very low volatility. Okay, so the question is, what's going wrong? Is the VIX measure completely wrong? Or is the view that we have hyper-uncertainty wrong? Okay, well, to look at that, let's look at some other index, which is an index that measures policy uncertainty, economic policy uncertainty. Now, that was developed by economists at Stanford and Chicago, and it's something that's used a lot now, especially among academics. Well, when we look at that, we get a very different story. Okay, so that's the global policy uncertainty index, and you can see that it's extremely high. And in fact, it's as high as at the worst time of the financial crisis. Okay. So by that index, we have what you would call hyper-uncertainty, no question about it. One interesting thing to notice about this graph, and I will get back to that, is that the index was extremely low immediately before the global financial crisis. Okay? This is the US version of it, and it's high as well. If you look at China, now over the last year, it has been as high as it ever was. And you look at Korea, it's extremely high in Korea. And in fact, in 2016, it reached a peak that was higher than it ever had. Okay, so we really have a story of two types of indices. We have the indices that look at uncertainty, and we have the indices that look at the information in the financial markets, and they get us very different stories. Okay? So if you look at the correlation of the two indices, if you look at how they move together, the first line is a correlation between the Korea Economic Policy Index and the VIX for Korea, and you can see that they don't move together very much. Okay? And that's true for all of those indices. They don't move much with the VIX. Okay? So the economic policy indices and the VIX give very different stories. But the VIX across the world are extremely highly correlated. Okay? So the VIX in Korea has a correlation of 80% with the VIX in the US. Okay? So those measures are very highly correlated. So the VIX is extremely low. Economic uncertainty is extremely high. So does that tell us that maybe something's wrong with the VIX? But other indices based on financial information are more consistent with economic policy uncertainty indices. If you follow the global financial crisis, people looked at LIBOR minus OIS all the time. Now, that's what they looked at when they woke up in the morning. And you can see why, which is during the crisis, it reached enormous levels. But that index is extremely low right now. Now, it had a bounce in 2015, early 2015, but now it is quite low. Something else that people look at in the markets is the spread between junk bonds and AAA bonds. Now, the riskiest bonds and the least risky bonds. And you can see that that spread is extremely low. It's one of the lowest that it has been. Now you can see it was extremely low before the global financial crisis and was extremely low before the Asian crisis. The last measure from the financial markets, that's from the stock market in the US, and it's from a paper that I recently wrote. And what we look at, the dark line is the idiosyncratic volatility of US stocks. So it's a part of US stocks that is not explained by the market as a whole. Okay? And you can see that idiosyncratic risk has been incredibly low. In fact, it hasn't been this low since the 1960s. Okay? So idiosyncratic risk is extremely low. Market risk is low as well. What is not low in the US is R-squared. So the market explains a lot more of the stock returns than it ever did. Okay, so the markets in the US are quite different from what they were for a long period of time, but the idiosyncratic risk, now which would reflect uncertainty, is actually extremely low. Okay, so the way the stock market is behaving is very consistent with the VIX. So what we have now is two different stories. The indices of policy uncertainties that I showed you show extreme uncertainty. The market-based measures show extremely low uncertainty. Now, I should have said the indices of policy uncertainties that I showed are indices that are based on looking at newspaper on how often people talk about uncertainty. Now, one thing about these market measures, now you would think, well, I mean, when the market has a lot of uncertainty, when the market measures show a lot of uncertainty, that may be just when we are getting bad times. But it doesn't quite work that way. Okay? And so that's kind of a risk of relying on those market measures. They tend to be very low before things go really bad. Okay? And so when you look at the VIX was extremely low before the global financial crisis. It was extremely low before the Asian crisis. Now, so it's not like the financial measures of uncertainty become very high and then things go bad. Things go bad and then the measures become very high. Okay? Now, in that sense, the VIX hasn't been useful to anticipate crises. the policy uncertainty wasn't that great to anticipate the global financial crisis either. Okay? By definition, crises are unexpected and they happen very quickly. So what's different now? I mean, the VIX is very low, same as before the Asian crisis, same as before the global financial crisis. The big difference between those two crises and the situation we are in now is that crises come from high leverage. When you think of the financial system, at least in the West, it's not very highly leveraged compared to before the global financial crisis. So leverage is much lower. Stock valuations are very high, but high stock valuations don't by themselves lead to crises. Now, what leads to crises is high stock valuations and leverage, and we don't have that much of the leverage part. Now, if we look at debt to GDP, it has been stable in the US, but it hasn't been stable in emerging markets. Okay, and so that's an area which is a source of concern. Here you see the debt to GDP ratio of the US. Now that's credit to the non-financial sector. And I compare it to Korea and I compare it to China. Okay, so credit in Korea has increased more than it has in the US, but not dramatically. What stands out here is what's happening in China. Okay, where the increase in credit has been pretty dramatic. Another way to look at that is what happened since 2007 in China. Now, total banking credit to non-financial sectors in China was 140% of GDP in 2007. 2015, it was at 240%. Okay, so we have a pretty dramatic change on rather enormous leverage. So what do we know about fast credit growth? What we know, at least from the academic literature, is that it often ends quite poorly. Okay, that what tends to happen is that the recessions that follow high credit growth are typically worse than recessions that don't follow high credit growth. Okay, and one piece of evidence on that is after a crisis, output still falls 3 years later if it was associated with high leverage and high credit growth. After a normal recession, output grows 3 years later. Okay, what we also know is that stock market performance is extremely poor following fast credit growth, and I will show you a result that the same is true at the bank level. Okay, and kind of the explanation for all of this that seems to become dominant is that people become over-optimistic with high credit growth. Now, the high credit growth partly results from over-optimism and feeds that over-optimism. So here is one set of results. Now, on the horizontal axis, we have credit expansion, and then we have the performance of the stock market in the 3 years, in the 3 following years, or the 2 following years. And that's from a paper by Baron and Thion. And you can see that kind of the very interesting result here, which is that knowing that you have high credit expansion allows you to predict very poor stock market returns, in fact, negative stock market returns. Okay? And so growth, fast credit growth leads to negative stock market returns over an extended period of time. With 2 co-authors, we looked at bank-level results, and what we found is that banks that grow the fastest in an economy now end up having poor stock returns, poor return on assets, and high loan provisions. Okay, and we find that for the US from 1973 to 2014. And the effects are quite substantial. And one way that we show that is suppose that you look at an investment strategy so that you go short the fast-growing banks and you go long the low-growing banks. Now, that's a straightforward portfolio strategy. It's extremely profitable. Okay, the equally weighted alpha of that strategy is 0.62% per month, and the value weighted is 0.43% per month. Okay, and that's relative to the French five-factor model. Okay, so that's an extremely profitable strategy that you can achieve by just going long the slow banks and short the fast banks. Okay? So all the evidence that I just showed now is fast growth leads to worse recession, fast credit growth leads to poor stock market performance, and that's true at the index level, and it's true at the bank level. Last part of my talk now we talked about credit growth, so you might say, well, we have too much finance maybe, but it's more complicated than that. Okay, we might really have too little finance rather than too much. Okay, and so if you think about financial institutions in the world, now the degree of recovery from the global financial crisis has been uneven. And when you think of the European banks, they really haven't recovered from the global financial crisis. The American banks have done better, but they still are not in the same position as they were. Okay, and one big problem that has emerged is that balance sheet capacity of the banks is much weaker compared to what it was before the global financial crisis. Now, that means that the ability of banks to use their balance sheet to support growth is much weaker. And that has lots of effects across the world. Now, I recently worked on a paper with a former student of mine where we look at the liquidity of the bond market in the US, which is a topic that has drawn a lot of interest. And what we find is that when there are spikes to the VIX in the US, liquidity in the stock market since the global financial crisis drops very sharply. Now, so it means that in periods of turmoil, the market makers, which are mostly the large banks, are not able to to accommodate the shocks. No? And so our concern is that that's in part the result of all the changes in regulations on the higher capital requirements that were brought about by the global financial crisis. Now, obviously here, are not as concerned about the U.S. bond market as people from the U.S. are. But the issue of dollar scarcity, which is closely related, is one that obviously is highly relevant for Korea and other countries. Okay? And that issue, kind of the best demonstration of this dollar scarcity issue is this graph, which I borrow from a famous Korean, now Yoon Shin, who is the chief economist of the BIS and counselor. Now the point here is, if you want to borrow dollars, you can borrow them in the US. Now, and that's the dark line, which is 3 months US dollar LIBOR. Or you can borrow them in, say, Germany in euros, convert it into dollars so that you have the dollars you wanted to borrow, and then pay back in euros, 3 months later. Now, the two approaches ought to have the same cost. Historically, they had exactly the same cost. Okay, but since the global financial crisis, they don't. And you can see the line, now the red line is a euro. It's much more expensive to borrow dollars by starting from euros and converting in dollars and then hedging than it is to borrow in the US. Okay, and the reason for that is the pricing of the forward contracts, the pricing in the currency swap market. Now, it's very expensive to hedge those dollar exposures, which is what people are talking about when they talk about dollar scarcity. Now, when you think about why this might be the case, now we have something that was holding forever. Now, I mean, that's for those of you who took economics courses, now it's called interest rate parity. and that held extremely well before the crisis, doesn't since then. Now that is a reflection of the fact that banks have very limited ability to finance international trade and have limited ability to finance arbitrage transactions. And that's a problem. Now, in the sense that if we want the financial institutions to support growth, they have to have room on their balance sheets. Currently, they don't. So, now we may be in an age of hyper-uncertainty. Financial markets don't show it. But in some sense, that might not be surprising. Okay? If markets are efficient, people don't wait around for a crisis. When they think a crisis is going to happen, it's going to happen fast. But the indices of policy uncertainties, they show considerable uncertainty. Now, we talked about one of the largest risks, and that has to do with credit growth. Now, we showed it for Korea, but it's obviously dramatically more so for China. We talked about the fact that credit growth often doesn't end up well. And we concluded by talking about the problems that the global banks have to support growth at this point in time because of their limited ability to use their balance sheet to use so. Thank you.